Equity, a word that echoes through boardrooms and balance sheets, but what is it really? Imagine your business as a treasure chest. Equity is your rightful share of that treasure. It's not just numbers. Equity tells the story of ownership, risk, and reward. Let's break it down. Assets minus liabilities equals equity. That's your net worth. If your business owns more than it owes, you're in the green. That's positive equity. But if the debts outweigh the assets, your equity turns negative, a red flag. Equity isn't just for Wall Street titans. It matters to startups, freelancers, even side hustlers. Your equity shows how much of the business you truly own after paying off all dues. Think of it as your financial fingerprint, unique, evolving, and deeply personal. There are two types of equity: owner's equity and shareholder's equity. Owner's equity refers to private businesses, what the entrepreneur actually owns. Shareholder's equity is for corporations. It shows the value left for shareholders. And yes, equity can grow. More profits, more retained earnings, more strength. But beware, equity can also shrink due to losses or excessive withdrawals. In investments, equity is your slice of the pie. The bigger the slice, the greater the influence. Investors love healthy equity. It shows sustainability and lowers financial risk. Banks look at it before lending. Strong equity signals creditworthiness. Equity also influences business valuation. Higher equity, higher price tag. When seeking partners or selling shares, equity is your bargaining chip. Think long-term. Equity is the foundation of generational wealth. It's not just about money, it's about control, credibility, and legacy. Track your equity regularly. Don't just guess, calculate it. Use balance sheets wisely. Equity is the bottom line that speaks volumes. In business, equity is power. Silent, numeric, but mighty. Master it, and you'll hold the keys to lasting wealth.